Close your eyes for a moment. Imagine it's a Tuesday morning. Your alarm hasn't gone off yet. The sun is just beginning to creep through your curtains. And somewhere across the city, a man named Vikram is already awake. Not because he has to be, but because he wants to be. He's sitting on his balcony with a cup of chai, watching the city slowly come to life below him. His phone buzzes. He glances at it. His investment account just received a dividend payment. His rental property manager just sent a rent confirmation. His digital course sold 3 copies overnight while he was sleeping. Vikram isn't a genius. He didn't inherit money. He didn't win a lottery. He didn't have a rich uncle who left him a fortune. 10 years ago, Vikram was exactly where he might be right now, working a job he didn't love, living paycheck to paycheck, wondering why no matter how hard he worked, the money never seemed to stay. Now, think about yourself. You wake up every morning. You get dressed. You commute. You work 8, 9, sometimes 10 hours. You come home exhausted. You sleep, and then you do it all over again, day after day, month after month, year after year. And at the end of the month, after all of that effort, after all that time, the money is gone. Bills, rent, EMIs, groceries, and the cycle starts again. Here's the brutal truth that nobody tells you in school, that your parents never explained because nobody explained it to them either. You are not poor because you don't work hard enough. You are financially stuck because you are only building income and not assets. Read that again. Let it sink in. Income is what you earn when you show up. The moment you stop showing up, when you're sick, when you're tired, when you're old, the income stops. That's the trap. That's the invisible cage that holds 90% of the working population hostage their entire lives. They trade time for money. And since none of us have unlimited time, we all eventually run out of the only currency that cannot be replenished. Assets are completely different. An asset is something you build, buy, or create once, and it keeps generating money for you long after you've moved on. It works when you sleep. It works when you're on vacation. It works when you're spending time with your family. It works when you're sick. It works when you're old. It never calls in sick. It never asks for a raise. It never quits. This is the secret that separates the wealthy from everyone else. It's not intelligence. It's not luck. It's not even hard work. Because some of the hardest working people on this planet are also the most financially vulnerable. The difference is this: wealthy people build and own assets. Everyone else builds someone else's assets while collecting a salary for the privilege. Now here's what makes this conversation different from every other financial video you've watched. We're not going to talk theory. We're not going to talk about vague concepts. Today, we're going to walk through 10 specific, real, proven assets, the exact categories that wealthy people around the world use to build generational wealth. And for each one, we're going to talk about what it is, why the rich love it, how it actually generates money, and most importantly, how someone with limited resources and no financial background can begin building it. Before we dive in, I want to give you a challenge. This is the Money Guru Challenge, and I want you to take it seriously. By the end of this audiobook, you're going to choose one asset from this list, just one, and you are going to take the first concrete step toward building it within the next 30 days. Not thinking about it, not researching it forever. One real action, because knowledge without action is just expensive entertainment. Here's something that will stay with you. There are 2 types of people listening to this right now. The first type will listen, feel inspired, say that was great, and go back to doing exactly what they were doing before. The second type will listen, identify their asset, and make a decision right now that their financial life is going to look different 1 year from today. Which one are you? The difference between those 2 people isn't talent, background, or money. It's identity. The first person still sees themselves as someone who doesn't understand investing. The second person has made a quiet, powerful internal shift. They decided, I am someone who builds assets. I am someone who makes money work for me. I am an asset builder. That identity shift, that moment of internal declaration, is where every wealth journey actually begins. Not at a bank, not at a brokerage account, not at a real estate office. It begins in your mind with a decision about who you are. So before we go any further, I want you to say this, either out loud or in your mind. I am not just an income earner. I am an asset builder. Good. Now let's build. The question people always ask is, where do I start? And the answer has always been the same. You start with understanding, because you cannot build what you cannot see. So let's start seeing these 10 assets clearly, one by one, starting with one of the most powerful and most misunderstood assets available to everyday people. But first, consider this. Most people who want to invest have been taught to be afraid of the stock market. They've seen family members lose money. They've heard horror stories. They avoid it completely, leaving one of the most proven wealth-building machines in human history completely untouched. What if that fear was based on a fundamental misunderstanding of how the market actually works? What if there was a specific way to invest in stocks, used by some of the wealthiest people on the planet, that actually rewards you simply for holding? A way where companies literally send you money every single quarter just because you own a piece of them? That's exactly what we're about to unpack. And once you understand it, you'll never look at stocks the same way again. Let's talk about Ramesh. Ramesh is a 32-year-old software engineer in Bangalore. He earns well, about 60,000 rupees a month. He saves about 15,000 after expenses. And for the first 7 years of his career, that 15,000 every month just sat in a savings account, earning 3.5% interest, barely beating inflation. He thought he was being responsible. He thought he was safe. Then, at a friend's birthday dinner, someone mentioned dividend investing. Ramesh went home, spent 2 weeks reading everything he could. He was skeptical. It sounded too simple. But he tried it. He started putting 12,000 rupees a month into dividend-paying stocks. Not speculation. Not tips from his brother-in-law. Carefully researched, fundamentally strong companies that have been paying dividends consistently for over a decade. 3 years later, Ramesh's portfolio sends him approximately 8,000 rupees every single month in dividends alone. He didn't have to do any additional work. He didn't have to show up anywhere. Those 8,000 rupees arrive because he owns pieces of businesses that generate profit, and those businesses share that profit with their owners. That's what a dividend stock is. When you buy a share of a company, you become a partial owner of that business. Some companies, typically mature, profitable, stable businesses, distribute a portion of their profits to shareholders on a regular basis. This distribution is called a dividend. It's not a bonus. It's not charity. It's your share of the company's earnings, paid to you simply because you own a piece of the company. Now, the critical thing to understand is this. Not all stocks pay dividends, and not all dividend stocks are worth owning. The mistake most beginners make is chasing high dividend yields without looking at the underlying health of the business. A company offering an 8% dividend yield might sound incredible, until you realize they're paying that dividend by taking on debt, which is unsustainable and will eventually collapse. What you want are companies with a long, consistent history of not just paying dividends, but growing them. These are businesses so profitable, so fundamentally strong, that they raise their dividend payments year after year. In the United States, these companies are called dividend aristocrats, companies that have raised their dividends for 25 or more consecutive years. In India, look for companies in sectors like FMCG, banking, and IT infrastructure with clean balance sheets and consistent payout histories. The real magic of dividend stocks isn't the quarterly payment. It's what happens when you reinvest those dividends. When you take your dividend income and use it to buy more shares, those new shares generate more dividends, which buy more shares, which generate more dividends. This is compounding. The phenomenon that Albert Einstein allegedly called the eighth wonder of the world, and it works with terrifying patience and precision over long periods of time. Here's the challenge within the challenge. Start tracking 3 fundamentally strong, dividend-paying companies this month. Don't buy yet if you're not ready. Just study them. Understand their business model. Look at their dividend history. Begin seeing yourself as a partial owner of a business, not a gambler in a market. What if you're not ready to pick individual stocks? What if the idea of researching companies feels overwhelming? What if you're worried about making the wrong choice? This is where the second asset becomes not just useful, but arguably the most powerful wealth-building tool ever created for ordinary people. Index funds. An index fund is deceptively simple. Instead of picking individual stocks, which requires research, time, and expertise, an index fund simply buys a small piece of every company in a particular market index. In India, that might be the Nifty 50, the 50 largest publicly traded companies in the country. When you invest in a Nifty 50 index fund, you instantly own a tiny fraction of 50 of India's most powerful businesses: Reliance, TCS, HDFC, Infosys, all of them. Here's why this is so powerful. Historically, over any 20-year period, diversified index funds have delivered consistent compounding returns. You're not betting on one company. You're betting on the continued growth of the entire Indian economy. And in a country of 1.4 billion people, with a growing middle class, expanding digital infrastructure, and an increasingly sophisticated financial market, that's a bet that has paid off for patient investors repeatedly. Warren Buffett, perhaps the greatest investor who ever lived, has repeatedly stated that for most ordinary people, a low-cost index fund is the single best investment they can make. He has even directed that the majority of his wife's inheritance be invested in index funds after his death. When the world's most celebrated stock picker says don't pick stocks, buy the index, that deserves serious attention. The most common mistake with index funds is not starting. People wait for the right time to invest. They want to buy when the market is low. But here's the reality. Nobody knows when a market is at its lowest point. The strategy that actually works, proven over decades, is called Systematic Investment Plan, or SIP. You invest a fixed amount every month, regardless of market conditions. When the market is up, your units are expensive. When the market is down, your units are cheap and you're getting more for your money. Over time, the average cost balances out, and the long-term growth of the market works in your favor. Think of it this way. If you started a SIP at just 5,000 rupees per month in a Nifty 50 index fund at age 25 and continued until age 55, assuming historical average returns, you would have contributed 18 lakh rupees in total. Your portfolio, thanks to compounding over 30 years, will be worth significantly more, potentially crossing 1 crore rupees. Not because you were smart, not because you got lucky, simply because you were consistent and patient. That is the power of the index fund. It democratizes wealth building. It takes something that used to require significant capital and expertise and makes it available to anyone with 500 rupees and a bank account. The identity shift here is crucial. Most people see themselves as not the type of person who invests in the stock market. They see investing as something rich people do. But here's the truth. Investing is how people become wealthy. The wealthy don't invest because they're rich. They're rich because they invested consistently, patiently, starting early. There's a man living in a small town in Rajasthan who's been putting 3,000 rupees per month into an index fund for 18 years. He's a school teacher. He never earned more than 35,000 rupees a month. Today, at 51 years old, his investment portfolio is worth more than most people in his city earn in a decade. Nobody taught him a sophisticated strategy. He simply started. He stayed consistent. He never panicked and sold. And the market, over 18 years, rewarded his patience. That's the story that never gets told, because it's not dramatic. It's not a get-rich-quick miracle. It's just a quiet, consistent, disciplined decision made over years. And it works. Now, while stocks and index funds are powerful, there's an asset class that most Indian families instinctively understand but rarely use strategically. An asset that has built more generational wealth in India than perhaps anything else. An asset that people touch, see, and feel, but often misuse completely. We're about to get into real estate, but not the way you think. Because most people approach real estate the wrong way, and it costs them decades of wealth-building opportunity. The difference between a real estate investment and a real estate trap is something most people never learn until it's too late. Let's make sure you're not one of them. There's a conversation that plays out in millions of Indian families every single year. A young couple gets married. Within a year or two, the pressure begins. Buy a flat. You need your own home. Renting is throwing money away. A home is a solid investment. And so the couple takes the plunge. They find a flat they can barely afford. They take a home loan for 20 to 25 years. They stretch their budget. And for the next 2 decades, their single largest monthly expense is their EMI, a payment that goes toward an asset that generates zero income. They are not investors. They are occupants. And there's a massive, critically important difference. A home you live in is not an investment in the traditional sense. It does not generate cash flow. It does not put money in your pocket every month. It costs you money in EMIs, maintenance, property tax, repairs. It may appreciate in value over time, but that appreciation is locked, illiquid, and inaccessible unless you sell or take another loan against it. A rental property, on the other hand, is a completely different animal. Meet Sunita. She's a 40-year-old woman in Pune who works in HR at a manufacturing company. 10 years ago, she and her husband bought a small 2-bedroom flat in a developing suburb of Pune, not to live in, but to rent out. They paid 38 lakh rupees for it. They took a loan, and their EMI was approximately 22,000 rupees per month. They rented the flat out for 18,000 rupees per month, which meant their net monthly cost was only 4,000 rupees. Over the next 7 years, as Pune expanded and the area developed, the rent increased to 28,000 rupees per month. Now their rental income exceeds their EMI by 6,000 rupees every month, meaning the property is paying for itself and putting money in their pocket. Today, that flat is worth approximately 80 lakh rupees. They have built 42 lakh rupees in equity. They receive a monthly rental income of 28,000 rupees, and their outstanding loan is minimal. That single decision, made 10 years ago to buy a flat for rental income rather than personal use, has transformed their financial position completely. This is what rental real estate actually means. You own a property. Someone else pays you to use it. That payment covers your costs and ideally generates surplus income. Over time, the property appreciates in value, while someone else, your tenant, effectively pays down your loan. It's one of the few asset classes where someone else builds your wealth for you. The common mistakes in rental real estate are predictable and avoidable. First, people buy in the wrong location, choosing based on personal preference rather than rental demand. The best rental properties are near employment hubs, educational institutions, hospitals, and transportation corridors. Second, people over-leverage. They take too large a loan, leaving no room for maintenance costs, vacancy periods, or interest rate increases. Third, people ignore the numbers. They fall in love with property emotionally without calculating the actual yield. Always calculate annual rental income divided by total property cost. If the yield is below 4%, you need to evaluate very carefully. But here's the reality that stops most people. Rental real estate requires significant upfront capital. Even a modest rental property in most Indian cities requires 10 to 15 lakh rupees as a down payment, plus registration, plus renovation costs. For someone just starting their wealth journey, that's a barrier that feels impossible. This is where the fourth asset completely changes the game, and it's one that barely 10% of Indian investors know exists. REITs, real estate investment trusts. A REIT is a company that owns, operates, or finances income-producing real estate. Think about commercial office spaces in Bangalore's tech corridor. Think about premium shopping malls in Mumbai. Think about warehouse and logistics parks serving e-commerce giants. These are all held by REITs. And when you invest in a REIT, you become a partial owner of these massive income-generating properties. In India, you can buy units of a REIT with as little as 10 to 15,000 rupees. And REITs are required by law to distribute at least 90% of their taxable income to investors as dividends. So you're getting regular income, quarterly distributions from premium commercial real estate without needing crores of rupees in capital, without managing tenants, without dealing with maintenance calls at 2 a.m. Embassy Office Parks REIT, Mindspace Business Parks REIT, and Brookfield India Real Estate Trust are the primary REITs listed on Indian stock exchanges. These companies own some of the most valuable commercial real estate in the country, occupied by multinational corporations, tech companies, and financial institutions. The mistake people make with REITs is treating them like regular stocks, buying and selling based on short-term price movements. REITs are income assets. You hold them for the consistent dividend distributions. You let the compounding of those distributions, reinvested over years, build your position. Here's something that will make you think. Warren Buffett's mentor, Benjamin Graham, wrote about real estate investment trusts in the 1970s as one of the most powerful democratizing forces in finance because they allow ordinary people to participate in institutional-grade real estate investments that were previously available only to the ultra-wealthy. The wealthy don't just own homes. They own income-producing properties. And through REITs, you can begin doing exactly the same thing. Starting this week, with a fraction of what a physical property would cost. But we're only at 4 assets. And the next 2, digital products and online business, represent perhaps the most exciting and accessible wealth-building opportunity in human history. Because for the first time, a person sitting in a small town with a laptop and an internet connection can build an asset that generates income globally 24 hours a day with virtually no physical overhead. The story I'm about to tell you will challenge everything you think about what's possible for someone with limited resources. And once you hear it, you'll understand why the internet has permanently changed the rules of wealth creation. In 2019, a 26-year-old graphic designer named Priya was earning 28,000 rupees per month working at a small advertising agency in Jaipur. She was good at her job. Her clients were happy. But she was exhausted, doing the same work repeatedly, watching her salary grow by 5% annually while her rent grew by 15%. One evening, she spent 3 hours creating a set of social media post templates, the kind of thing she designed every day for clients, but packaged into a clean, downloadable product. She uploaded them to a platform called Creative Market and priced them at $9 per pack. She told no one. She forgot about it. 3 weeks later, she checked her account. 47 people had purchased her template pack. She had earned $423, approximately 35,000 rupees, from a product she created once in 3 hours while watching television. Priya had, without realizing it, built her first digital asset. Today, Priya has 31 digital products across 4 platforms. She still does some client work because she enjoys it, but her digital products generate between 1,20,000 to 1,80,000 rupees per month in passive income. She works from a beautiful rented apartment in Udaipur. She travels 4 months a year. Her income doesn't depend on how many hours she works. It depends on how many products she has built and how many people find and buy them. This is the extraordinary power of the digital product as an asset. A digital product is any product that exists in digital form, downloadable, consumable, and infinitely reproducible at zero additional cost. Templates, ebooks, online courses, presets, software tools, music, photography, fonts, spreadsheet tools, financial calculators, Notion databases, video tutorials. The list is essentially unlimited. Because wherever there's a problem that can be solved through knowledge or a tool, there is a potential digital product. What makes digital product extraordinary as an asset class is the economics. When Priya sells her template pack, she doesn't have to make a new one for each customer. She makes it once. The platform stores it. The customer pays. The platform delivers it automatically. Priya receives the money. Her cost to serve the 10,000th customer is identical to her cost to serve the first. 0. Compare this to service business, where you exchange time for money. If you're a freelance designer, every project requires your active involvement. You can only scale by charging more or working more hours. Both have natural limits. A digital product has no such limit. In theory, it can sell to 10 million people with no additional effort from you. The mistake most people make with digital products is waiting until they feel like an expert. They think, I'm not qualified enough. Who will buy something from me? But here's the truth. You don't need to know everything. You need to know more than the person you're helping. If you figured out something that others are struggling with, that knowledge has value. Package it. Sell it. The other common mistake is creating products nobody wants. Before building anything, spend 2 weeks in relevant online communities, Facebook groups, Reddit forums, Quora, Twitter, and look for the questions people ask repeatedly. Those repeated questions are market demand. Build the answer to a repeated question, and you have a product with a built-in audience. Now let's zoom out to the 6th asset, an online business. An online business is broader than a digital product. It might combine product services affiliate income, advertising revenue, and subscription models into a cohesive business that operates largely or entirely online. And what makes it an asset, rather than just a job, depends on one critical factor: systems. The difference between an online business that is an asset and one that is just a digital job is whether the business runs when the owner isn't present. A business that requires the founder be involved in every transaction, every piece of content, every customer interaction is not an asset. It's a self-employment situation with a website. Consider two content creators. The first creates content daily, manages all brand partnerships personally, responds to all comments, and handles all administrative work. Their business is entirely dependent on their daily presence. The second has hired a video editor, uses a scheduling tool for social media, has templated responses for common brand inquiries, and has built multiple income streams: AdSense courses, merchandise, affiliate links that generate income regardless of whether they post that day. The second person has built an asset. The first has built a high-effort job. In India, we are living through the golden age of online business creation. Internet penetration is expanding rapidly. The creator economy is growing. E-commerce is exploding. Regional language content is creating new audiences. A person who can identify a gap in the market, build a solution, and systematize delivery of that solution can build something extraordinary. Here's the Money Guru Challenge extension for this block. Spend 30 minutes today listing 5 problems you have personally solved in the past year. They don't have to be sophisticated. Did you figure out how to file ITR returns easily? Did you learn to cook a specific cuisine efficiently? Did you find a way to manage your household budget effectively? Did you develop a system for learning a new skill quickly? Every one of those solutions is a potential digital product or content business waiting to exist. The question is not whether you have something worth sharing. The question is whether you'll give yourself permission to share it. But here's what separates truly wealthy creators from those who just earn a comfortable living. The wealthy don't just create content or products. They create intellectual property. They build assets that generate income not just a day, but potentially for decades, or even beyond their lifetimes. This is the 7th asset, and it might be the most underappreciated wealth-building force in the modern economy. The story of how a 40-year-old man's idea, written down over 6 months, has generated hundreds of millions of dollars over decades. Long after he stopped actively working, will completely reframe how you think about your time and your knowledge. In 1936, a man named Dale Carnegie published a book. He called it How to Win Friends and Influence People. He was a public speaking instructor who had spent years teaching people how to communicate more effectively. He had no grand plan for global domination. He just wrote down what he knew, organized it into a coherent format, and published it. 88 years later, that book has sold over 30 million copies. It is still selling today in every major language, in every major country. Carnegie died in 1955, but the royalties from that book continued generating income for his estate for decades after his death. That one piece of intellectual property, one document, one idea organized into words, has generated wealth across generations. That is the incomprehensible power of intellectual property as an asset. Intellectual property, or IP, refers to creations of the mind, inventions, literary and artistic works, symbols, names, designs, software that are protected by legal rights. When you create intellectual property and register or protect it, you own something that can generate income repeatedly, often with minimal additional effort. For most people, the most accessible form of IP is knowledge packaged in a structured format: a book, a course, a training program, a proprietary framework, a methodology. These are all forms of IP, and once created, they can generate royalties, licensing fees, and passive income for years or decades. Let's look at this closer. An author writes a business book. It takes them 6 months of focused work. The book is published. Over the next 10 years, it sells 40,000 copies at 300 rupees each, generating 12 lakh rupees in royalties, assuming a 10% rate. The author did not write it 40,000 times. They wrote it once. The distribution system, publishers, Amazon, Kindle, bookstores, deliver it 40,000 times. The author's time investment was 6 months. The return stretched across a decade. Now scale this up. A software developer creates a productivity tool, a simple app that helps freelancers track their time and generate invoices. They spend 4 months building it. They charge 500 rupees per year for a subscription. Over 3 years, they acquire 8,000 subscribers. Annual revenue, 40 lakh rupees. The developer still works, maintaining the software, adding features, but the core asset, the software code, was built once. It is their intellectual property, and it generates income at a scale far beyond what any single person could achieve by trading hours for money. The mistake people make with IP is waiting for a perfect, revolutionary idea. They think intellectual property has to be groundbreaking. It doesn't. The most valuable IP is usually not the most original. It's the most clearly useful. A framework that helps someone solve a common problem more effectively. A process that simplifies something complicated. A tool that does something manually time-consuming automatically. You have ideas right now, ways of doing things, systems you've developed, knowledge you've accumulated, that other people would pay for. The question is whether you'll take the time to package and protect them. Now let's talk about the 8th asset, which is closely related but deserves its own deep examination. Books and content assets. Content assets include books, YouTube channels, podcasts, newsletters, and any media that continues to generate income or influence after the initial creation effort. These are perhaps the most democratized form of wealth-building asset in human history, because the barriers to entry have collapsed completely. Consider Ankur Wariku, an Indian entrepreneur and author. His YouTube channel, his books, and his online courses form a content asset ecosystem that generates substantial income year-round. Each piece of content he has ever created continues to exist, continues to be discovered, and continues to deliver value and income long after the day it was made. His 2018 YouTube video about failing is still generating views and therefore advertising revenue. Today in 2025, he created it once. It continues to work. This is a concept of evergreen content. Content that remains relevant and valuable over a long period of time. How to file your taxes, how to negotiate your salary, how to start investing, how to communicate more effectively. These topics don't expire. A well-made video, article, or book on an evergreen topic is an asset that can generate income for years. The YouTube channel itself becomes an asset, not in the sense of a piece of equipment you can sell, but in the sense that a channel with a substantial, engaged audience has consistent advertising revenue, sponsorship value, and the ability to sell products and services to a warm, trusting audience. Channels have been sold. Newsletters have been acquired. Podcasts have been bought by media companies. These are not hobbies. They are assets. For the Indian creator, this moment is extraordinary. YouTube is the primary video platform for 1.4 billion people, with a rapidly growing creator monetization program. Podcasting in regional languages is exploding. The newsletter ecosystem is maturing. A person who begins building a content asset today, consistently, with genuine value, is planting a tree whose shade they will enjoy for decades. Here's the identity challenge I want to leave you with before we move forward. Most people consume content. They watch, listen, read, and give their attention freely to other people's content assets, making those creators wealthier with every view. The asset builder sees content differently. They see every piece of valuable knowledge they have as raw material for a content asset. They see their unique experience as a story worth telling. They ask not who want to hear from me, but who needs what I know. You have more intellectual property sitting dormant in your mind right now than you realize. The question is whether you'll build the courage and the discipline to extract it, package it, and put it to work. But individual content assets, while powerful, have natural limits. The greatest wealth, the kind that creates true freedom, comes from building something larger than any single product or piece of content. It comes from the two remaining assets we're about to discuss: businesses with systems and skills that generate income. These two assets, when combined, create the foundation for everything else on this list. And the story of how an ordinary man in a small Indian city built an extraordinary financial legacy using exactly these two assets will change how you see your own potential. His name was Rajan. He ran a small printing shop in Coimbatore. For 12 years, he worked 16-hour days. He was the printer, the designer, the salesman, the delivery person, the accountant, and the janitor. His business survived entirely on his personal effort. The moment he fell sick, which happened twice, severely, over those 12 years, the business stopped generating income. Everything depended on him being present, healthy, and working. Then, at 44 years old, Rajan had a health scare that put him in the hospital for 3 weeks. And during those 3 weeks, with no income coming in and a family depending on him, he made a decision that would change everything. He decided to build a business instead of having a job. The difference sounds subtle. It is actually enormous. Over the next 2 years, Rajan hired and trained a production manager. He created standard operating procedures for every process in the shop, from client inquiry to final delivery, so that any trained employee could execute them without him. He built relationships with 3 anchor clients who provided consistent volume. He invested in better equipment that reduced labor requirements. He created a pricing structure and sales script so his new salesperson could close deals independently. He implemented accounting software so his finances ran themselves, with weekly automated reports. By year 2, Rajan was working 4 hours a day at the printing business. In year 3, he was visiting twice a week. The business generated more revenue than it ever had when he was working 16-hour days, because the systems attracted better clients, reduced errors, and created capacity for growth. With his freed time and growing income, Rajan opened a second business, then a third. Today, at 56, he owns 3 businesses that run largely without his daily involvement. He earns more than 30 lakh rupees a year. He takes 2 international trips annually, and he will tell you, without hesitation, that the day he stopped being an employee of his own business was the day his life changed. This is the 9th asset, a business with systems. Robert Kiyosaki, in Rich Dad, Poor Dad, describes the difference between being self-employed, where you own a job, and being a business owner, where you own a system. The self-employed person earns money when they work. The business owner earns money when the system works. The goal of building a business as an asset is to create a system so well-designed that it can operate, grow, and generate income without requiring the owner's constant presence. The key elements of systemized business are documented processes that any trained person can follow, reliable team members who execute those processes, automated tools that handle repetitive tasks, clear metrics that tell you whether the business is healthy, and recurring revenue streams that provide predictability. None of these are available on day one. They are built deliberately, patiently, over years. The common mistake entrepreneurs make is building a business that depends entirely on their personal skills, relationships, and presence, essentially creating a very demanding job for themselves with no ceiling and no escape. They become so essential to the operation that they cannot step away without the business deteriorating. They are trapped more elegantly than someone in a 9-to-5 job, but trapped nonetheless. Building a business as an asset requires a different mindset from the beginning. You build not just to fulfill orders today, but to create a machine that will fulfill orders for years. Every process you execute yourself, you ask, can this be documented? Can this be delegated? Can this be automated? Over time, the answers to those questions transform a self-employment situation into a genuine asset. Now for the 10th and final asset, and this one surprises people because it doesn't fit the traditional definition of a passive income asset. But I would argue it is the most important asset on this entire list. High-value skills. A skill is an asset when it generates income that significantly exceeds the time invested in developing it. A doctor's surgical skill generates income far beyond the hours of practice required to develop it. A software engineer's ability to build AI-integrated applications generates income at a level no amount of physical labor could match. A skilled negotiator who can close multi-crore deals generates income through knowledge and communication ability, not physical effort. The key distinction is this. A skill becomes an asset when it is rare, valuable, and can be leveraged to generate income beyond one-to-one time exchange. The goal is to develop skills so specialized and in demand that you can charge premium rates, work selectively, and eventually teach, license, or productize those skills, turning them from a service into an asset. In today's economy, the highest leverage skills include the ability to build and deploy AI tools, advanced digital marketing, particularly performance advertising and SEO, financial analysis and investment advisory, content creation in high-demand niches, software development, particularly in emerging technology areas, persuasive copywriting, and high-ticket sales. Here's the crucial insight about skills as assets. The income ceiling on skills is determined by demand and rarity. A skill that 10,000 people have generates modest income. A skill that 100 people have generates extraordinary income. Therefore, the most powerful wealth strategy for someone starting from scratch is to deliberately combine skills in ways that are uniquely rare. Be the person who understands both finance and content creation. Be the person who combines AI development with a deep understanding of a specific industry. Be the person who can both build software and sell it. These combinations are rarer than any individual skill and command proportionally higher income. Now, let's talk about the mistakes that stop people from building any of these 10 assets. Because knowing the assets is only half the battle. The other half is understanding the traps. The first and most destructive mistake is starting nothing because you're waiting to start everything. People build elaborate plans. They research extensively. They buy courses. They join communities. They talk about what they're going to do, but they never actually begin because beginning feels permanent and frightening. Here's the truth. The worst plan executed is infinitely better than the best plan that never leaves your head. The second mistake is diversifying too early. When you have limited capital and limited time, trying to build all 10 assets simultaneously is the fastest way to build none of them well. The correct approach is to choose one asset, focus on it with all available resources, build it to a point where it generates consistent income, and then use that income and knowledge to begin a second asset, sequentially, not simultaneously. The third mistake is ignoring compounding because the early results feel disappointing. An index fund SIP of 5,000 rupees per month generates almost nothing visible in the first year. 200 rupees in dividends, 500 rupees in gains. It feels meaningless. People quit. But compound interest works on a curve, not a straight line. The growth is almost invisible in the early years, and then it becomes overwhelming in the later years. The people who quit before the curve turns steep are the ones who spend the rest of their lives wondering why they never built wealth. The fourth mistake is treating income and assets interchangeably. Every additional rupee of income that goes into consumption, a nicer phone, a more expensive car, a larger apartment, is a rupee that could have been deployed as an asset. Lifestyle inflation is the silent destroyer of wealth. Every time your income increases, the most powerful wealth-building decision is to keep your lifestyle constant and direct the additional income toward assets. How do you start with limited money? The answer is the same regardless of your starting capital. You start with what you have, as consistently as you can, in the direction that makes the most sense for your situation. If you have 500 rupees per month, you start at SIP. If you have a valuable skill, you create your first digital product. If you have time and knowledge, you start a YouTube channel or a newsletter. The size of your starting capital is far less important than the consistency of your commitment. For someone in the middle class, earning 20 to 60,000 rupees per month, with limited savings and significant expenses, the most practical sequence is this. First, build an emergency fund covering 3 to 6 months of expenses. Second, begin a modest index fund SIP. Third, develop and monetize a high-value skill to increase income. Fourth, use increased income to accelerate the index fund SIP and begin building a digital product or content asset. Fifth, as assets generate income, diversify into dividend stocks and eventually real estate or REITs. It's not glamorous. It's not fast, but it is absolutely certain to work if followed consistently over years. The question is never whether the system works. The system works. The question is always whether you will. I want you to imagine 2 lives. Both begin today. In the first life, you listen to this audiobook, feel genuinely inspired, and then, because life is busy and habits are hard and the future feels distant, you do nothing. You keep working your job. You keep spending most of what you earn. You think about building assets occasionally, late at night, in that quiet space between exhaustion and sleep. But you never start. Years pass, and at 50 or 55 or 60, you find yourself in exactly the same position, financially dependent on your next paycheck or your pension, without the cushion or freedom that assets would have provided. In the second life, you make a different choice. Today, not next week, not when you have more money. Today, you identify one asset from this list. You take one concrete first step. Open a brokerage account, create the outline of a digital product, research 3 dividend-paying stocks, look at REIT unit prices, write the first draft of the first chapter of the book that's been sitting in your mind for years. One step, and then tomorrow you take another, and the day after, and the month after, 5 years from today. In the second life, you have assets generating income you didn't have to trade hours for. 10 years from today, those assets are generating enough that your job is optional. Not because you're rich beyond imagination, but because your asset income covers your essential expenses. 15 years from today, you have financial security that most people never achieve in their entire lifetimes. You are not exceptional. You did not get lucky. You simply started and stayed consistent. The difference between those two lives is not intelligence. It is not talent. It is not even money. It is a decision made on one specific day, which happens to be today, to become an asset builder. Let's talk about the force that makes the second life inevitable once you commit to it. Compounding. Compounding is not just a financial phenomenon. It is a universal law of growth. The idea is simple. Returns generate returns. Momentum builds on momentum. When your assets generate income and you reinvest that income into more assets, the growth accelerates over time, slowly at first, and then with breathtaking speed. Consider an investment of 10 lakh rupees in a diversified portfolio, some index funds, some dividend stocks, earning an average of 12% annually. In year 1, the return is 1,20,000 rupees. Modest. In year 5, compounded, that original 10 lakh has become approximately 17.5 lakh. In year 10, it's grown to over 30 lakh. In year 20, that original 10 lakh investment is worth approximately 96 lakh, almost 1 crore, without a single additional rupee added. But what if you continued adding to it? What if, alongside that initial 10 lakh, you contributed 10,000 rupees per month from your active income? In 20 years, at 12% annual return, your total contributions will be 24 lakh rupees above the original 10 lakh. 34 lakh in total invested. Your portfolio value? Approaching 3 crore rupees. 3 crore. From a starting investment of 10 lakh and a monthly contribution of 10,000. This is not a fantasy. This is arithmetic. The math works. It has always worked. The only reason it doesn't work for most people is that they never start, or they start and stop, or they panic during market downturns and sell. Now, the power of compounding multiplies further when you add multiple income streams. The wealthy do not have one source of income. Study after study has confirmed that the average millionaire has 7 income streams. Not because they started with 7. They started with 1, built it to stability, then added a second, then a third. Over years, those streams compound upon each other, each one funding the development of the next. Imagine this progression. You start with your job, income stream 1. You use part of that income to begin a SIP. Your index fund generates investment returns, which becomes income stream 2. You use skills from your job to create a digital product, a template pack, an ebook, a mini course, which generates passive income. Stream 3. You grow a YouTube channel around your professional knowledge, which generates AdSense revenue and sponsorship income. Stream 4. Your growing investment portfolio generates dividends. Stream 5. You buy a small property and rent it. Stream 6. Your digital business grows to the point where it can be partially systematized. Stream 7. None of these happen overnight, but each one flows naturally from the previous. Each asset funds the next. Each stream widens a river, and at some point, different for everyone, but inevitable if you continue, the combined income from your assets exceeds your expenses. That is the moment of financial freedom. Not the moment you become a millionaire. Not the moment you can afford anything you want. The moment your assets generate enough to cover your needs and your modest comforts. That is the moment you become free. Because financial freedom is not about a number. It is about options. It is about having the power to say no. No to the job that's slowly killing you. No to the toxic environment you've been tolerating. No to the life you settle for because you believed you had no choice. Assets give you choices, and choices are freedom. Let's talk about what freedom actually feels like. There's a retired schoolteacher in Kerala, a man named Suresh, who spent 30 years teaching mathematics at a government school. He earned a modest salary. He never had a windfall. But for 30 years, beginning at age 30, he put 15% of every paycheck into a combination of mutual funds and dividend stocks. He never touched the money. He never panicked during market crashes. He simply stayed consistent, year after year, decade after decade. At 60, when he retired, his portfolio was worth over 2 crore rupees. His dividend income alone was approximately 80,000 rupees per month, more than double his final teaching salary. He did not retire because he had to. He retired because he wanted to, and he had the asset base to support that decision. He still teaches, but now he tutors students from his home garden by choice, for the joy of it, charging whatever he wants, taking only the students who genuinely want to learn. That is what assets buy you, not just money. Time, choice, dignity, the ability to live life on your own terms. Now, let's make this concrete. This is your 30-day action plan, the Money Guru Challenge, and I want you to treat it as non-negotiable. In the first 7 days, your only job is clarity. Sit with a notebook, not a phone, a physical notebook, and answer 3 questions. Which of the 10 assets speaks to you most strongly? Which asset is most aligned with the skills, knowledge, and resources you already have? What is the single smallest action you could take this week to move toward that asset? In days 8 through 14, you take that smallest action. If it's investing, you open a brokerage account and set up a SIP. If it's a digital product, you research market demand and write a product outline. If it's a YouTube channel, you write the script for your first video. If it's a rental property, you spend time understanding the real estate market in one specific neighborhood. One small, concrete, real action. In days 15 through 21, you go slightly deeper. You learn more. You consume resources specifically related to your chosen asset. You find one community, online or offline, of people building the same type of asset. You connect with one person who is ahead of you in the journey. In days 22 through 30, you take the second concrete action. You make your first investment. You publish your first piece of content. You launch your first product imperfectly before you feel ready, because you will never feel fully ready. You list your property. You start. That's it. 30 days for specific actions, not perfection, not mastery, just beginning. Here is the psychological truth behind why this works. Identity is formed through action. The person who says, I am an asset builder, but takes no action is building a fantasy. The person who takes a small, imperfect, hesitant action toward building an asset is beginning to build an identity that will compound, just like the assets themselves. Every action reinforces the identity. Every deposit you make to your SIP makes you more of an investor. Every piece of content you publish makes you more of a creator. Every system you build in your business makes you more of a business owner. The identity grows in the direction of your consistent actions. And the identity, I am someone who builds assets, is the most powerful wealth-building force that exists because it changes how you see every financial decision you make. You stop seeing the latest phone as a reward you've earned. You see it as capital that could be deployed as an asset. You stop seeing a salary increase as permission to upgrade your lifestyle. You see it as fuel to accelerate your wealth building. You stop seeing financial freedom as something that happens to lucky, exceptional people. You see it as a natural result of consistent decisions made by someone who has decided to be the kind of person who builds assets. That person is you, not someday, not when the timing is right, not when you have more money, more time, more confidence, more clarity. Now, with what you have, starting from where you are. Vikram, the man we met at the beginning of this audiobook, sitting on his balcony watching the city wake up, was not always that man. There was a version of him that worked a job he was exhausted by, wondering why the money never stayed, wondering if financial freedom was a real thing or just a story told to sell books. The only difference between that version of Vikram and the version who wakes up to dividend notifications is the moment he decided to stop being only an income earner and start being an asset builder. One decision, years of consistent action, a completely different life. Your moment is right now. You have heard about dividend stocks, income while you sleep. You have heard about index funds, the market working for you, compounding silently over decades. You have heard about rental real estate, someone else paying down your wealth. You have heard about REITs, institutional real estate available to everyone. You have heard about digital products, creation once, income forever. You have heard about online business, systems working without your presence. You have heard about intellectual property, your mind generating royalties. You have heard about content assets, knowledge compounding into audiences. You have heard about businesses with systems, machines generating wealth. You have heard about high-value skills, expertise leveraged beyond time, 10 assets, 10 paths, one destination, a life where money works for you, instead of you working only for money. The seed of financial freedom has been planted today. Whether it grows depends entirely on whether you water it with action, with consistency, with patience, and with the identity of someone who builds instead of just earns. 30 days, one asset, one action. Begin.